I watched people lose everything in 1929. Smart people, educated people, confident people. They did not lose money because they were stupid. They lost money because they paid too much. If you want protection from market crashes, remember this rule. Never buy something for more than it is worth. And even more important, always buy it for less than it is worth. That difference is called a margin of safety. Let me be clear. The stock market goes up. The stock market goes down. It has always done this. It will always do this. If falling prices destroy you, the problem is not the crash. The problem is the price you paid. Let me explain what margin of safety is. If something is worth $100, do not pay $100. Do not even pay $95. Pay $70, maybe $60. Why? Because you might be wrong. The company might earn less. The economy might slow down. Management might fail. You need room for mistakes. That room is your protection. During a crash, prices fall fast. People panic. They sell because everyone else is selling. But ask yourself this. Did the company suddenly stop existing? Did the buildings disappear? Did the customers vanish overnight? Usually, no. Only the price changed. If you paid too much, you panic. If you paid far less than value, you stay calm. Most people do the opposite. When prices are rising, people feel safe. They buy at high prices. When prices are falling, they feel afraid. They sell at low prices. This behavior destroys wealth. It has done so for over 100 years. The market does not reward emotion. It rewards discipline. Investing is not guessing. Investing is not predicting the future. It is not following trends. It is not listening to rumors. Investing is simple. Find out what something is worth, then pay much less than that. That is all. Anything else is gambling. In the market, you must accept that your estimates will not always be correct. You are not perfect. You will make mistakes. That is normal. This is why the margin of safety exists. But if you buy without protection, you are acting as if you cannot be wrong. That is arrogance. Markets punish arrogance. Imagine two men buy the same company. The company is truly worth $100. The first man pays $150 because he believes it will grow quickly. The second man waits and pays $60. A crash comes. The price falls to $80. The first man panics. He is losing money. The second man is calm. He is still protected. Same company, different price, different outcome. The market behaves like a moody person. One day it is excited. Another day it is depressed. You do not have to follow its mood. You only need to decide whether the price makes sense. If it does not, you wait. There is no rule that says you must act. Patience is power. Safety comes first. Many people focus only on profit. That is a mistake. Your first job is not to make money. Your first job is to avoid losing it. Because if you lose 50%, you must gain 100% just to recover. Losses hurt more than slow growth. Protect yourself first. Grow later. If you remember only one thing, remember this sentence. The price you pay decides whether you survive a crash. Not the news, not predictions, not opinions. The price. When markets fall, most people feel fear. If you bought wisely, you feel opportunity. If you bought carelessly, you feel regret. The crash does not change value overnight. It only reveals who was careful and who was careless. Crashes will happen again. They are normal. They are part of markets. You cannot stop them, but you can prepare for them. Buy with a margin of safety. Demand a real discount. Be patient. Be strict. Be unemotional. If you do this, crashes will not destroy you. If you ignore it, they will. The choice is yours. And the rule is simple. Pay less than something is worth or do not buy it at all. Many investors buy growth stories. They chase the latest trend. Listen carefully. A company growing fast does not guarantee safety. A rising price does not guarantee profit. You are not investing in hype. You are investing in value. If the price is too high, no growth can protect you. When the market turns, hype evaporates, and you are left holding losses. Markets will test your patience. They will tempt you with rising prices. They will frighten you with falling prices. Do not act on impulse. Do not react to noise. Do not follow hot tips or the latest trends. Your only guide is value. Your only rule is safety. Patience is power. Haste is ruin. Consider this. 1929, crash destroyed fortunes. 1987, Black Monday wiped out thousands in days. 2008, housing bubble collapse created panic. The names of the victims change. The mistakes remain the same. Those who ignored margin of safety suffered. Those who respected it survived. History repeats. Do not be blind. Panic is contagious. Greed is contagious. Fear spreads faster than reason. If you purchased without thinking, panic will force you to sell. If you purchased with discipline, panic becomes opportunity. Do not to be a slave to emotion. Crashes are not just danger. They are opportunity. Stocks fall below value. Businesses with real assets, good earnings, and strong management become cheap. The disciplined investor acts slowly, not out of fear, not out of excitement, out of calculation. Price falls, not business value. Act only if there is margin of safety. Most investors ignore these rules. They chase quick profits. They borrow money. They believe growth excuses price. And they fail. You do not have to. Follow the margin of safety. Respect valuation. Ignore speculation. The market does not reward emotion. It rewards discipline. The markets will crash again. Buy less than value. Ignore the noise. Survive the crash.